Good morning, students. Welcome back to the derivative session. Let us first in first 10-15 minutes recap what we have studied, and then we will go and solve a lot of questions today. So what we studied in the previous session, we started from a basic definition of a derivatives, which says that which is a financial instrument. A derivative is a financial instrument whose value is dependent on an underlying, and hence it is called as a derivative because it is deriving its value from an underlying. We also studied that what are the types of underlying. It can be an equity of any company. It can be an index, which is the market portfolio of all the equities put together, which is BSE, NSE. Then we also studied that it can be Forex as well. And also it can be a commodity. Then we studied certain common features of all the products of derivatives. So first of all, there has to be a buyer and seller of the derivative who is separate from the buyer and seller of the underlying. Then we also said that again, the main feature of a derivative is the value is dependent on the value of underlying. Then there is an expiry or time limit to the entire product. And after the expiry, there is a settlement. On the settlement, there will be payoffs generated to the buyer and seller. And we also studied that there are certain conditions that are fixed or specified, and there are some other conditions that are non-fixed, or which we can say that those are variable. For example, an underlying asset and the quality of that asset, the quantity of that asset, the time period, all of them are fixed in most of the derivatives. But the value, which is the price of the financial instrument, is totally variable. Then we studied about our first type of derivative, which is the forward contracts. So we said that forward contract is a very over-the-counter product, which is the over-the-counter contract, which says that on a future date from today, the rates at which the transaction has to be done is fixed today. And in this, we studied about this case study on the procurement manager, wherein he needs after 6 months some crude oil and he locks the rate today only, so as the delivery and the payment happens basis the 110 rupees in future date. Then, and in forwards, we also studied that forwards are over the counter contracts in which the settlement will happen on a gross basis, not on net basis. The payment will be made and the delivery will be taken. Then we studied on the futures contract. So futures contract, we said that it's conceptually, everything is same as forwards, except to some of the following things. One is this: these are the standard contracts. Futures are standard contracts which are traded on stock exchanges, unlike forwards, which are very over the counter contract. Then we also said that in this case, the settlement happens on net basis, not on gross basis, and no actual delivery, no actual payment. Only whatever is the payment will be done for the net loss, or the payment will be received for the net gain. And then we also studied that how the settlement payoffs will be calculated. Yes, so here is the difference where we studied. So there is this cash market or spot market, which is the main underlying asset. And there are two different types of products that we studied. There are two different types of derivatives. One is forward and one is futures. Forwards, we said this, and futures, we said this. Then the next very, very important thing for us was on the compounding piece. So compounding, as we can see that there are different cases that we covered. But at the end, we said that this is the main formula that we have to remember, which is A is equal to future value. A is future value is equal to P means present value, 1 plus R divided by N raised to the power Tn, where we said that R is percentage per annum, T is time period, and N is number of times compounding in 1 year. We also have studied what is the logic building for these formulas. Then lastly, we said that there is a term called continuous compounding, because in practical life, the return accrues every second, not every day, not every month, not every week. It accrues every second. So that is called as continuous compounding. And the formula for continuous compounding was A is equal to P E raised to the power R T, where E is a constant which has a fixed term. Then the next concept was we studied on how to value a forward or future. This we also called as theoretical minimum price, because theoretically the minimum price of a forward or future should be calculated by this formula. It was very easy. The concept says that you have the present value, which is the spot market value, and you know what is the value is going to be after 3 months. So you just simply calculate the future value basis the above two formulas. So price of a forward or future, we studied that is equal to future value of the spot price. Simple. And expiry is equal to time period we have to take. Now, in this case also, we studied different permutations combination. The first one was the discrete compounding. In case we have a discrete compounding, we know that this is the formula. In case of continuous compounding, we know this is the formula. This is from the above. Now, in this, we introduce certain complications about the dividend as well as the transaction cost. So, in this treatment of dividend and transaction cost, we studied that so dividend is always reduced from the spot market value because futures does not entitles the holder of a future for a dividend, because company does not pay dividend on futures. They always pay dividend on what they have issued as equity shares. Hence, we have to reduce this dividend, and the transaction costs are always added because the transaction costs form part of the overall cost only. So hence the transaction cost will be added. The only line of confirmation here, or the line of attention here, is that we have to always take the present value of both the factors, because it might be given that dividend is payable after 2 months, but while adjusting it in the present value in the formula, we have to take as the present value of dividend. Okay. And then we said that in case of a continuous compounding, the formula instead of this will look like e raised to the power RT. Simple. Now, the last concept in valuation that we studied is what if there is a continuous dividend also? Apart from continuous compounding, there is a continuous dividend as well. So in this case, we will use this formula, which is PE raised to the power R minus YT, where R is the annual percentage per annum return and Y is the continuous dividend on per annum basis. And then the bottom line of all the things that we studied is that the price of a future will always be equal to the spot price at the time of expiry. Once the expiry is there, so using this diagram, we said that initially the gap is higher, then it eventually keeps on coming lower. The reason being because the time element is getting reduced, and hence on the spot price, on the expiry, the spot price will be equal to the future price. Then we studied about the question number 1, and then we said that what are the uses of these derivatives. Now, in terms of uses, we said that there are two broad objectives using derivatives, what people want to achieve. One is the speculation, and second one is the hedging. So in case of speculation, we said that speculation is just a speculation about future, that in the future the prices are going to go up or going to go down. Hence, there is a hope of gain with a risk of loss. Now, in speculation, there is only one transaction that happens because the information is there with the trader that how the prices are going to go up or going to go down. However, in hedging, we already are exposed to one risk, and that risk is protected using derivatives. That is called as hedging, because in hedging you are already exposed to a risk, and that we also covered. See, this we also covered through this example, in which there is a already shares purchased with some trader, and he's already exposed to a risk of what? Price may go down, correct? Hence he can do the hedging using the futures. We will cover a lot of questions today to make sure that this conceptual building is completed. Now let us go to the question number 2. So question number 2 says, the following data relate to Anand Limited's share price. So we are given the current price per share as 1800, 6 months futures price per share. So they have also given the 6 months future price per share, which is 1950. Sorry, assuming that it is possible to borrow money in the market for transactions in securities at 12% per annum. So they are saying that R is equal to 12% per annum, and basically the 1800 and 1950, these are the two different rates for two different markets that they have given us. If you see, this is a cash segment or the cash market. This is the futures market. Then you are required to calculate the theoretical minimum price. Again, the term they are using is theoretical minimum price of a 6 months forward purchase. Now, students, please note that we have already studied how to calculate the 6 months theoretical price. Although in the same question, we are already given that what is the 6 months future price. But as of now, basis this 1800 and this 12% and the 6 months, which is the time is 6 months, they're asking us to calculate that what is the theoretical minimum price. So calculation of theoretical minimum price. Now, students, in this case, we so there are three ways to apply the formula, correct? One is that we can again take the e raised to the power rt, which is a continuous compounding. The second one that we studied was the discrete compounding, correct? So I am using the simpler one here because we have to see that what is the objective of the question. If you see in the question number one, we were already given that what is the e raised to the power. Okay, in this also, it clearly said that it was monthly rest. But what I'm trying to say is that sometimes in question itself, they give you that what is the e raised to the power something, and hence that will help you to solve the question. But in this case, I am taking the normal interest calculation, ignoring the continuous compounding. Okay. So it will be 1800, which is the spot price, plus 6 months interest on 1800. 12% multiplied by 6 by 12. If we calculate this, the price comes as 1908. So this is the forward 6 months forward purchase price. So basically forward price, we can simply say not purchase, but normal price. Now students, if you see that as per the calculation, if we have a rate of return of 12% and there is a 6 months maturity of a forward or slash future, then it should be valued at 1908 given the spot price is 1800. But if you notice, the actual future is trading at 1950. I should mention here as future only, not forward, because in the question we are using the term future. 6 months future price. Okay. Now what I'm trying to say is that as per the calculation, it is coming out to be 1908, but the 6 months future price per share in market is getting traded at 1950. So there is something in market getting traded at a higher price, correct? Now, if we see the second part of the question is asking us to calculate the arbitrage opportunity. So first of all, for calculating an arbitrage opportunity, we need to see that what exactly we need to sell and what exactly we need to buy. Because arbitrage is what? Arbitrage is riskless profit, correct? So I'm just explaining the concept of arbitrage here. Arbitrage is actually riskless profit. So What does it means? It means that you have to devise a strategy in such a way of sale and purchase, or basically buy or sell. We have to devise a strategy that what to buy and what to sell, so that after some time, after some days or after some month, whatever the price comes out to be, whether up or down, you are still able to make some gain out of it. Okay. And now let us try to understand from this question how we can get it. Now there is a spot price that is given as 1800. In the spot market, we are given that the price of an equity share is 1800, and in derivatives, we are given that the currently it is trading at 1950. Now, students, if you see, okay, Harshad is saying if you use compound interest formula, then the answer is coming is this. That's okay, Harshad. We can use that as well. Now, what I'm trying to say is that in case of derivatives, 1950 is there. Don't you think that derivatives are overpriced? Because the implied value or the theoretical minimum price that we have calculated, TMP, theoretical minimum price, should be 1908, correct? However, the actual value in the market is equal to 1950. So don't you think that something whose value should be 1908, actually it is 1950? That means it is overpriced. Overpriced, if anything is overpriced, without going into any technical concept, our mind will always say that it has to be sold. We need to sell that. If something is overpriced, if something is underpriced, we will buy it. And this we have studied during the previous sessions as well. So from here itself, we get a direction that we have to sell the derivative, sell the futures in derivative, correct? Because this is the product that we are talking about. And since we are in already derivatives market, we have taken a sell position because our futures are overpriced. Hence, in the spot, we will take a buy position, or we will say that we will purchase share here. Okay. Now, let us try to validate our answer with the help of solution, because this is what we are able to devise a strategy. This is a strategy that you purchase a share in spot market and you sell a future in derivatives market at the rate of 1950. Now, students, if you see, let us try to calculate that what is the net impact. So the cash flow, initial cash flow, if we see, is what? First of all, because for an arbitrager, because this is the arbitrager, we always assume that he don't have any money. So he will take a loan first of how much? 1800. Then he will buy a share. So the cash flow will be nil. The initial cash flow will be nil. But after initial cash flow, he will hold one share. Correct? This is the initial calculation. Now, cash flow on settlement, which is after 6 months. Okay. After 6 months, now what is the amount that he's going to realize after selling this one share? So students, as we discussed in the earlier session, is if we are selling a future, that means we are entering into a contract to sell the equity share after 6 months, correct? This is what a selling a future means, right? If you see this, short position in derivatives means a contract to sell on expiry. And short position was the sale part, correct? Long position is purchase part and short position is this. So hence, there's a contract to sell on expiry under derivative, which is this futures. And what is the rate at which it will get sold? It will get sold at 1950. So after 6 months, he will sell and realize. After 6 months, sell and realize how much? 1950, correct? And there will be a loan repayment. Loan repayment will be 18. What was the price? 1800 plus interest on this, which is calculated as 12% multiplied by 1800 multiplied by 6 by 12 for 6 months. Yes. So this comes as already 1908, which is nothing but our theoretical minimum price only, which we have already studied. So this will be a reduction. And would there be any other cash flow apart from this? No. So there is a 42 rupees of profit that he has earned. This is called as riskless profit or arbitrage. What was asked to us exactly? Arbitrage opportunity we have explained, and hence this is a arbitrage gain of 42 rupees. Whatever price will be there in spot market after 6 months, he will still be getting 42 rupees only. You can try and test with as many cases as possible. You will still get 42 rupees in every other case. This is the beauty of arbitrage concept. But how to devise this arbitrage concept is one thing that we have to be very clear. So we have to take at least one position first in one market, then the second position in the second market is clearly visible. Now, in this only, students, I have to tell you some more things. So I hope till here it is clear, and this is what till question has asked us to calculate and to explain the arbitrage opportunity. Now, this is actually called as cash and carry arbitrage. So we call this is called as cash and carry arbitrage. In this, we purchase an equity share and we sell a future. So basically our trigger point is what? I'm just noting it down so that in revision it helps all of you. If forward is overpriced, I'm using forward and future terms interchangeably as of now. Then short sell forward as a first step. Then next step will be borrow money. Then next step will be long, or we say buy one spot asset. This is called as cash and carry arbitrage. Okay, students. Now, if we extend this question further, this is still now. Now, if we extend this question further, instead of 1950, if the question says that currently the 6 months future is at what price? Is at, let's say, 1850. This is the current price at which it is getting traded. Okay. Then in that case, what will happen is, in this case, if you see the theoretical minimum price is how much, is equal to 1908 again, correct? And the actual price is how much? 1850. What is this priced as? This is priced as underpriced. The reason being, something which has a value of 1908 is getting traded in the market at 1850. So that means this particular future is underpriced. If it is underpriced, then we will purchase the underpriced asset, correct? We will purchase the underpriced security. Why? Because if something is underpriced, then definitely it will fetch you some gain. So in this case, what we are going to do is, we are going to long forward. That's our first step. Then, now as a second result, what we have to do is, if we are taking a long position in derivatives, we have to take a short position in cash or cash market, correct? Cash or spot market. So, but while taking a short position in cash market, is it allowed? As per the yesterday's discussion, as per the last session's discussion, what we have studied is the short selling in a spot or cash market is only allowed for an intraday, right? Not for intraday. It is only allowed for an intraday. Hence, what we have to do is, because at the time of settlement, we will not be able to produce our share for the delivery, correct? So what we are going to do is, we are going to borrow an asset, borrow equity share, and after borrowing, we short sell this equity share, and after short selling, whatever money we get, that we invest or lend the money at our percentage. Our percentage is the same percentage using which we have calculated the theoretical minimum price. Lend means we have to invest here. Okay. Now what will happen on expiry? On expiry, after you close all these positions, so what will happen is, first of all, you have long forward. So you will get a again riskless gain of how much now? 1908 minus 1850. This is what you are going to get, because what will happen in the initial cash flow, it will be zero. Now if I say that cash flow on settlement, which is after 6 months, how will it look like? So first of all, since we have lended the money, invested the money, the realization of money will happen. Realization of investment will be 1800 plus interest on 1800, which is 1908. This is our cash inflow. And since we have done a long forward, that means we have purchased a forward, and hence in this we are saying that we have done a contract to buy on a future date. And at what price we are going to buy? Minus 1850. This is the price at which we are going to buy the security. Minus 1850. Purchase of security under the future. Correct? And once we purchase it, we will give it to the borrower to the lender from whom we borrowed this equity share. Simple. Once we purchase the security on maturity, we will give that security back from whom we borrowed it. So this comes as 58 rupees. Here, the arbitrage gain will be 58 rupees. This is riskless gain. And this entire process is called as reverse cash and carry. Simple. Reverse cash and carry. The above process is called as cash and carry, and this is called as reverse cash and carry, just to remember. So we have covered both the techniques or both the strategies, how to formulate it if there is some question asked on the arbitrage front. So we have to always think it that these are two different markets that are operating. In one market, we have to take one position, and second market, we have to take the second position. Now let us come to the question number third. Now question number third says that on 31st of August 2011, the value of the stock index was 2200. This is the value of the stock index. That means this is actually the underlying, correct? Because this is simply the BSE or NSE index that they are saying. The risk-free rate of return has been 8% per annum, which is R is equal to 8% per annum. The dividend yield on this stock index is as under. They have also given us that these are the different dividend yields month on month that keeps on changing. But remember, this is a percentage per annum. Please don't get confused that it is a 3% for the entire month of January. No, it is 3% for entire 12 months in January that was there. Then in February, it was 4% per annum that has been changed. And as per the question, we are somewhere here on 31st of August 2011. We are here. This is 31st of August 2011. Correct? Assuming that interest is continuously compounded. Now in question, very categorically or very specifically, they have specified that it is continuous compounding. Find out the future price of a contract deliverable on 31/12/2011. And they have given us a E value equivalent that can be used. Now we are sitting here and we have to calculate the future value as on 31st of December. Simple. So if you say students, how much would be the duration? 1 month, 2 months, 3 months, and 4 months. So we can say that the duration or time to expire is equal to 4 months. Now the second thing that comes is, since it is continuously compounded, how we will be calculating the future price. So in case of continuous compounding, we can use the following formula, which is A is equal to PE. Now in this, is there a dividend also involved? Yes. And whether that dividend is also getting continuously compounded? Yes, because they have said that it is continuously being compounded. So hence PE raised to the power R minus Y T. We are going to use this formula, correct? Now in this, A is what we have to calculate. P is what? P is the current price that is also given to us, which is 2200. 2200 multiplied by E raised to the power. Now what is R? R is also given as 8%. Now this comes the Y part. Now what dividend rate should we use here? Whether it should be for September, for October, for November, or for December. So we can use the simple average on dividend yield is as follows. What is the simple average here? September is 3, October is 3, 4, and then 3. So 3 plus 3 3% plus 3% plus 4% plus 3% for 4 months divided by 4. So the average dividend yield is how much? Is coming to be 3.25 percentage. That means on an average basis in these 4 months, the dividend that will accrue to a stock index will be 3.25 percentage per annum. This is what the simple interpretation is. And hence A will be, again, I'm putting in the same formula, 3.25. So 8 percentage minus 3.25 percentage. Now, what is the time here? As I told you that always in our formula, T is equal to 1 for 1 year. So here it is T for 4 months will be 4 divided by 12. So in the power itself into 4 divided by 12. Now, if we solve this, 2200 multiplied by e raised to the power. So if we solve this part here, only this part, it will give us as 0.01583. Okay. And hence A will be 2200 multiplied by 1.01593, which if we solve it, it comes as 2235. Sorry. So it is coming as 2235.05. This is what the final answer is. So hence we are saying here that what was the exact requirement in question? Find out the future price of a contract. So the future price of the contract is 2235.05, deliverable on 31/12/2011. This is what the question was asking us to calculate. What is the future price of the contract that is deliverable on 31/12/2011? Now, this was a good question in terms that it has asked us to identify the average dividend yield, correct? Because otherwise we might be under a confusion that which dividend percentage to be used. But ideally, since it is spread across all the 4 months, hence we have taken the simple average and calculated the answer here. And how we have identified that for dividend also it has to be continuous compounding. There are two indicators towards this. One is that the dividend is given in percentage per annum terms. So that clearly indicates, since it is given in percentage per annum, it would be apt to adopt the continuous dividend formula. Correct? Otherwise, it would be difficult for us to first calculate the dividend and then take the present value and then redo the future price there. Let us come to the question number 4. Students, please again, if you have something in terms of in any doubt in this session or for the previous session related to derivatives, please do ask the questions. Now, this question number 4. Yeah. Question number 4 says that calculate the price of 3 months PQR futures if PQR face value of 10 quotes 220 rupees on NSE. So this quotes 220 means this is the spot price. First of all, the face value is given of 10 rupees. So that means that 10 rupees face value equity share is getting traded as 220 on NSE. And the 3 months future price quotes at 230. They have also given us the 3 months future price also. And the 1 month borrowing rate is given as 15%, and the expected annual dividend is 25% per annum payable before expiry. Now, students, please note, although in this the percentage is given on an annual dividend, but it also says that it is payable before expiry. That means the dividend here is a discrete dividend. Okay, let me explain it through this time chart. Today is 0, here it is 3 months. So today we have been given that spot price is how much? 220 rupees. Face value is how much? 10 rupees. And the future price that is currently being traded is how much? 230 rupees. Okay. They have also given us that monthly interest rate is how much? Is 15%, although it is per annum, but it is at monthly rest. That means compounding will happen monthly. Compounding will happen monthly. That means n is equal to 12, number of times the compounding in a particular year. Correct? And just on expiry, they will pay a dividend. Dividend is how much? 25%, but on 10 rupees, because dividend is always paid on face value. So this 25% is expressed on 10 rupees, which is the face value. So this comes as 2.5 rupees. Simple. This is what the question is saying. Now, using all this, we have to calculate the theoretical minimum price of future as on today, because using that only we will be able to examine the arbitrage opportunities. So we don't have any other option, but we will have to apply here the compounding interest, because it in the question itself it says that 1 month borrowing rate. That means after every 1 month the compounding will happen. So we know that A is equal to P1 plus R divided by N raised to the power Tn. So here T is given as, what is the 3 months, right? So 3 by 12 is T, because if 1 is 1 year, so 3 months is 3 by 12. R is also given as 15%. N is what we've already seen above is 12. And P is the spot price, which is 220. Now we have to just put it in this formula and calculate whatever is the amount. But one thing which we also need to be cautious is of the dividend, because dividend is payable on expiry. So what we are going to do is minus dividend on expiry. Now there are two ways to use this dividend here. One is that in this only we could have done this present value of dividend, correct? And then we could have multiplied 1 plus R by N raised to the power Tn, correct? This is what the formula also we have studied. But in this case, if you see, dividend is exactly payable on expiry. So there is no point in first taking the present value and then again doing the future value. It will be 2 times. But if the dividend is payable at a different date than expiry, then definitely we have to do first present value and then do a future value. But here, since the dividend is exactly payable on expiry, hence we will just go ahead with this formula. which is dividend. We will, from the overall value, we will minus the dividend on expiry. So this comes as 220 multiplied by 1 plus 15% divided by 12 raised to the power. T is 3 by 12 multiplied by 12. N is 12. And minus 25 percentage on 10. This is the dividend. This is the normal value. Dividend we have just taken and reduced it because it is payable on expiry only. So this comes as 220 multiplied by 1.0379 minus 2.5. So this comes as 228.36 minus 2.5. So the future price is equal to 225.86. Okay, students. So this is what the future price as per the formula or the theoretical minimum price should be for a future on of 3 months on PQR limited. Is it PQR? Yes, PQR limited. Now the second part of the question also asks us to examine the arbitrage opportunities. So the second part is arbitrage opportunities. Okay. Now, in this case, what we have to see is, first of all, we have calculated the theoretical price on futures. So the theoretical value is how much? 225.86 that we have already calculated. 3 months future is getting traded at 230. Now this is clearly overpriced because the actual price at which it is trading is 230 and the theoretical value is 225. That means we will have to sell the overpriced security. The overpriced security is what here? 3 months future. So sell futures. So what we are going to do is sell futures at the rate of 230. Then after selling futures, take loan at the rate of 220 and purchase equity share at the rate 220. So initial cash flows will be nil. Okay. Harshad is asking that in the question it says that 15% is the 1 month borrowing rate. So Harshad, if you see, the question says that the 1 month borrowing rate is given as 15% and the expected annual dividend is 25% per annum. So basically what the question is trying to say here is that 1 month borrowing rate, that means at every 1 month the compounding has to happen and the annual rate of interest is 15%. Okay. Hence, we have divided 15 by 12 because 15% is still the per annum rate, which is payable will 1 month rests. Okay. So on settlement, what will happen here is, first of all, we will sell the stock at 230 rupees. Correct? Because we have already sold a future at 230. So that means the rate at which the security will be sold on expiry is logged as 230. Then there will be a loan repayment. Now loan, how much we have taken? 220, correct? Multiplied by what would be the interest? Okay, Harshad. So what would be the interest is 221 plus 15% divided by 12 raised to the power 3 by 12 multiplied by 12. This is what the loan repayment will be after including the interest compounded monthly, correct? Which is what coming out to be 228.36. 228.36. This is coming as a minus because this we will have to pay loan out of 230 rupees. Then now here is the different point from the earlier question that we have solved. In this part now, what is this the only arbitrage profit 230 minus 228.36, or are we missing something? Yes, we are missing the dividend here, because since we hold a future here, sorry, since we hold a equity share here, what we have said is take loan and purchase equity share. Since we have purchased an equity share just before expiry, we will be entitled for a dividend also. So plus dividend of 2.5 rupees. Simple. That means 4.14 will be the arbitrage gain. Correct? And once the stock that we have sold, we will have to deliver the share that we have, and we will have to repay the loan that we have taken initially. This is how the arbitrage in this case will look like. Since in this case there was a dividend, hence we have to see the arbitrage profit including dividend. And the last bottom line here, which I am again telling, is always the arbitrage gain will be the difference between the theoretical value and the actual value, which is this 230 minus 225.86, which is 4.14. From this also you can just tally the or reconcile the answer. Okay, students. So this is what the question number 4 was saying in terms of to calculate and to analyze the entire thing. Now let's go to question number 5. So the question number 5 says that BSE 5,000, value of portfolio 10,10,000, risk-free rate is 9% per annum, dividend yield on index. Now this is a continuous compounding, correct? 6% per annum, and beta of portfolio is 1.5. Now there is a portfolio, there is BSE. BSE is the market. Portfolio is the smaller portfolio that they have formed. Now what they are saying is we assume that a future contract on the BSE index with 4 months maturity is used to hedge the value of portfolio over next 3 months. See, students, okay, let me explain you about hedging in detail here. So students, till now what we have studied is that X Limited's hedging will be done through X Limited's future. This is equity of X Limited and this is future of X Limited, correct? These are two different markets. But for X limited equity share, the hedging will be done by X limited future by taking the opposite position. Can we do X limited's hedging with the index futures? This is equity again, but here we are not using X limited futures, but we will be using the index futures. Yes, we can do that because X limited is related to index through beta. Through beta, they both are related, correct? So for example, if X limited beta is 1.2, the market goes up by 1, the equity share will go up by 1.2. If it is 0.8, this is market percentage. This is the X limited's percentage. So if it is 1%, it will be 0.8 percentage. Simple. So using this, we can easily say that hedging is possible using the index as well. Now, what are the basic principles while we want to do the, just a second, while we want to do the hedging here. So students, please note these some of the principles. First is that if we have to use the same stock, we have to use the same stock hedging, then in this case, what we will do, we will operate in cash and derivative market. We will make use of these two markets. And in this, what we will do is take equal and opposite exposure / position. So let's say for one long we are taking in cash market, so the one short we will take in derivatives market, so as to do the perfect hedging. Now in case we are using through market index, which is the case that I have explained above, in this case what we need to do is that we need to use the beta minus required beta multiplied by the number of shares. This much of amount, whatever is this amount coming out to be, this much of amount has to be covered through the market index. Okay, we will understand it better from the question. But what we are trying to say is here that the amount of hedging will come from the beta adjusted number of shares. Now let's say beta is positive. If beta is positive, then what will happen? Beta is positive, then both index and beta are moving in the same direction. That means that, correct? Hence, we will have to take opposite position. Take opposite position. For example, now equity share is having a positive beta and equity share will go up. The index will also go up. Hence, to do a hedging, what you'll have to do is you will have to take a opposite position in index futures. Correct? Then only you will be able to hedge it, because opposite movements you will have to build. And if beta is negative, then take same position. Because if beta is negative, already they will move in the opposite direction. So we will just take the same position. If we have taken long, we will take long in index futures. If we have taken short in equity market, we will again take short in the index futures market. But here, if it is long, then we will take short. Here, if it is short, then we will take long. Simple, because of the logic that we have explained. So this explains that what direction we have to take, correct? And this explains that what amount we will have to take. This amount part will be clear once we solve the question, but the what direction is very clear from this table. Same stock is very easy. Same stock, there is no issue as such. Okay. Now let us go to the question number 5 and see. Now what they're saying is that there are two markets here. One is the portfolio itself, and one is the index futures. Both of them are related with a beta of 1.5. This is the beta of 1.5. Since both of them are related with a beta of 1.5, the portfolio and index futures can be used to hedge against one another. Now, beta is positive. That means if portfolio is increasing, then index future will also increase, correct? Hence, what we'll have to do is, we'll have to take the opposite position. In case we are buying the portfolio, we have to sell the index future. Okay, now let us solve the question. And what they are also saying is that the portfolio over next 3 months can be perfectly hedged by using a 4-month index, because the index is a standard instrument that is there in the market, this index future, and the index future standard availability is at 4 months, but they are saying that still that 4 months maturity can be used to hedge for the value of portfolio over next 3 months. Now, based on the above information, calculate the price of future contract. What they have also given us additional is one future contract is for delivery of 50 times the index. That means they're giving us here lot size is equal to 50. Simple. Now, first calculate the price of futures, which is very easy and very simple. Price of futures. In this case, I am again applying the simple interest here because we are not given the any other factor to derive the other part. So, which is 5,000 is the spot price plus 5,000 multiplied by 9% minus 6% multiplied by 4 by 12. This is the R percentage. This is the dividend yield percentage. And 4 months is the 4 months of the expiry of that index. So using this, it comes as 550. So the price of future, rather A I should put here, the price of future on BAC index comes as 5,050. Okay. Now, in this, we'll have to just, in this formula, I'm just making a small change. Instead of number of shares, we will say value of shares. Okay. Now the price is this much. The second part of question is the gain on short future position if the index turns out to be 4,503 months. Simple. So it says that after 3 months, now students, please note here, it is not saying on expiry. Again, it is not saying on expiry. It is saying after 3 months, the index turns out to be 4,500. Then what is the gain on short futures position? First of all, what position should we take? Well, hedging, because they are saying that it used to hedge. So while hedging, what position should we take? Already we are holding a portfolio. Holding a portfolio means we are already having a long position in portfolio. So definitely we will take a short position in index futures. Correct? Because beta is positive. If beta is negative, then we could have taken a long position only. But since beta is positive, we are taking a short position, and hence Short position is what question is also saying to us. Question is also saying that if you have taken a short position on futures, what does the index, what would be the gain on that? Correct. So first of all, we have to see that how many number of contracts to hedge the portfolio. This would be how much? This will be 10,000. Sorry, 10 lakh 10,000 is the value of portfolio. Correct. Multiplied by beta is 1.5 minus what is the beta required? Beta required is 0 because we have to reduce our risk down to 0. This whole divided by 5,050 is the price of one future, and 50 such futures are in one contract. That means is equal to 6. So if we solve this, it comes as 6. So that means we have to short sell 6 contracts of 50 futures each at 5,050 rupees. Simple. And this is nothing but the equation that we have studied, this one. The beta minus beta required multiplied by the value of portfolio. So our recommendation is that short 6 contracts. This is what BSE. 6 contracts on BSE. Then what is the gain in futures? Now students, please don't do a mistake here to calculate the gain simply like this. We can't do it like this. So 6 into 50, I'm just putting the wrong thing first so that we don't do this mistake. So 5,050 is what the short price is, and 4,500 is after 3 months the index turns out to be. This is wrong. Because this 4,500 is not the settlement price. It is after 3 months. However, our contract is for 4 months. So we have to adjust this price for 1 month. See students, this is based on 4 months. This is based on 3 months. We cannot use and compare it and calculate the gain or loss. What we'll have to do is futures price at 4 months simply. Futures price at 4 months will be 4,500 plus 4,500 multiplied by 9% minus 6% multiplied by 1 by 12. So if we take the accrual of 1 month on 4,500, we will reach to the 4th month closing value. So the future price on the 4th month will be 4511.25, which is the closing price. Okay, students. So this is what the closing price will be. Now this will be used to calculate the gain or loss, not the previous price. Sorry. So the gain on futures will be 6 are the number of contracts. 5050 is the price at which we have short sold in initial month. 4511.25 is the closing rate, which is the lesser value multiplied by 50. So it comes as 1,61,625. This is the gain that is coming on account of dealing in futures. And hence, whatever is the loss that has been incurred in the value of portfolio will be compensated by the gain. Correct? Because if the index is going downside, that means the stock will also be going downside only because the beta is 1.5, right? But the question is not asking us to calculate the net gain or loss in both the situations. The question is only asking us to calculate the gain on futures, that's all. In case at the closing, the price turns out to be something else. Okay, students? I hope the principles of hedging are clear with this question. What has to be done in case there is an index involved in question to do the hedging? Let us go to the question number 6. Yes. So the question number 6 says that, sorry. So the question number 6 says that a mutual fund is holding the following assets in rupees crore. Now, this is a very good question, which involves a lot of things that we have studied till now. So it is saying that there is an investment in diversified equity shares of 90 crores. There is a cash in bank balance of 10 crore, and hence there is a total corpus of 100 crores that is available with a mutual fund. The beta of the equity share portfolio is 1.1. So the beta here is 1.1. And we know that cash and bank balance beta is 0 because it will not change. Cash and bank balance will not change in relation to the market. The index future. Now, apart from this, they are saying that there is an index future also is selling at 4,300 rupees kind of a level. The fund manager apprehends that the index will fall at the most by 10%. So from 4,300 level, it will come down to 10% less. How many index futures he should short for perfect hedging? Now we know that index is going down from 4,300 level, it will go down to 10% more. And it is asking us that how many futures should be used for perfect hedging. Now, perfect hedging will be achieved for the portfolio of diversified equity shares once we know that there is a beta related value adjustment, correct? Because as per the principles of hedging, what we have to do is, first of all, we'll have to calculate the number of contracts for perfect hedging. This will be calculated how? 90 crores multiplied by 1.1 is the index, correct? Minus 0. Perfect hedging means that the beta should become 0. So the required beta is 0. This entirely divided by 4,300 multiplied by 50. 50 is the contract size and 4,300 is the current price of the future that it is selling at it. So 4605 becomes the number of contracts. So the number of contracts is equal to 4605. Now, if the index falls by 10%, now what is the second part saying? Substantiate our answer assuming that the fund manager's apprehension will materialize. So they are saying that in case the index falls by 10%, then how you are so confident that your entire loss will get offset by this gain? Now, if index falls by 10%, in that case, first of all, portfolio will fall by how much? portfolio will fall by 11 percentage, which is 10 percentage multiplied by 1.1. 1.1 is beta. So beta means that it is in relation to the market. Whatever market falls, it will multiply the beta with that fall, and with that value, the portfolio will fall. So the loss on portfolio will be how much? 90 crores is the portfolio multiplied by 11 percentage, which becomes 9.9 crore will be the loss. And index gain will be how much? Index gain will be, because we have short sold the index, any reduction in the price will result into a gain in index. So gain on portfolio will be 10% multiplied by 4605 is the contract size, multiplied by 50 multiplied by 4300, because from 4300 level it will go down to 10 percentage lesser. So here the gain is coming out to be 9.90075 crore. Hence, we can say that the loss is completely offset by gain in index future. So students, if you see here, the loss is completely offset by the gain in index futures. Why? Because we have done a complete hedging. Complete hedging, because we have seen that what is the beta adjusted value of the portfolio, that value we have hedged. Okay. Okay, students. So let's go to the next question. Question number 7. Now, the question number 7 says a trader is having in its portfolio shares of worth rupees 85 lakhs at the current price. So the value of portfolio of shares is 85 lakhs that is currently having, and 15 lakhs of cash. That's okay. That means total 100 lakhs is he holding. The beta of the share portfolio is 1.6. So this has a beta of 1.6 and this has a beta of 0. Correct? Because cash has a beta of 0. After 3 months, the prices of the shares dropped by 3.2 percentage. Determine the current portfolio beta. Portfolio beta is very easy to calculate. How we can calculate the portfolio beta? By just multiplying it with the respective shares. Shares is how much? 85 divided by 100 multiplied by 1.6. This comes as 1.36. Then cash is how much? 15 by 100 multiplied by 0. Because 0 is the beta of cash, it is 0. So that means 1.36 is the current portfolio beta. We have just multiplied it with the respective weight. Simple. To calculate the portfolio beta, we have just multiplied with the respective weight. This we have also studied in our portfolio management, how to calculate the portfolio beta. And the second part is saying portfolio beta after 3 months. If the trader on current date goes for a long position on 100 lakh Nifty futures. Now, if you see, already the trader was long on shares. He has taken again a long position on futures also, which is not as per the arbitrage, which is not as per the hedging principle. But still, if he has done that, we will go with that thing only and we will solve the question. Okay. So what we are saying is on 100 lakh Nifty futures, he is going for a long position. Now let us try to put all the things here. First of all, 85 lakhs shares having a beta of 1.6. He is long on that. 15 lakhs cash having a zero beta and 100 lakhs Nifty at the rate of 1. He is also long. So this is what the question is given us. Naveen is asking, sir, so to arrive at number of contracts to short or long, future price is considered and not the spot price. Yes, Naveen, because you will long or short futures basis the current future price, not basis the current spot price. Okay. So hence to arrive at the number of contracts, we will use the future price, not the spot price. Okay. Because you will deal in futures, not in spot. Correct? So the 85 lakhs 1.6 beta long position, 100 lakhs Nifty 1 beta long position. Now what happens after 3 months? After 3 months, first of all, percentage change in shares is how much? 3.2%. Okay. Before this, students, I would request all of you to note this one more formula also here, which is beta is equal to percentage change in portfolio divided by percentage change in market index. Simple. So if percentage change in portfolio, percentage in market index we are given, we can calculate the beta. Simple. Correct? Because it says that what is the percentage in portfolio in relation to percentage change in market index. In these three variables, beta, portfolio change percent, market index percentage, whichever one thing we are given, we can put that and try to calculate the other thing. Simple. Now in this, percentage change in shares is given. Beta is also given of these shares. That is how much? 1.6. So the percentage change in market can we calculate? In market index will be 3.2 percentage divided by beta of 1.6. Correct? So this comes as 2 percentage. So the percentage change in market index will be 2 percentage. This is one of the missing information that we have calculated first of all. Okay. Now, first of all, the market index has gone up by 2 percentage. It is false. Sorry, just a second. What is the question mentioning? Dropped by 3.2 percentage. Sorry. So the market goes down by 2 percentage. The shares portfolio goes down by 3.2 percentage. These are shares. This is market. So what is happening here is that both of them are going down, and in both of them he's having a long position. So he will lose. He will incur a loss here as well as he will incur a loss. Why? Because in both the markets he's having a long position. So loss on futures. 100 lakhs is the futures that he has purchased, and 2% is the loss. That means 2 lakhs he will lose. Revised cash position will be how much? He was holding 15 lakhs minus 2 lakh is the loss. That means 13 lakhs is his revised position, cash position. Okay. And the revised shares value is 85 multiplied by 1 minus 3.2 percentage, which is coming out to be 82.28 lakhs. 82.28 lakhs. Okay. This is what the revised share value will be, because the shares will also drop by 3.2 percentage. Correct. So the revised portfolio is equal to 13 lakhs of cash plus 82.28 lakhs of shares. This is cash and this is shares. So hence it is coming out to be 95.28 lakhs. Revised portfolio. Now, what is the percentage change in portfolio value? Percentage change in portfolio is calculated how? 100 was the initial value, 95.28 is the revised value divided by 100, the original value. Correct? So that means the change in portfolio is coming out to be 4.72 percentage. And the beta is what? Percentage change in portfolio divided by percentage change in market. This is 4.72 percentage divided by 2 percentage. Simple. So the beta is 2.36. This is the revised beta after taking the calculation on the losses that he has incurred in both the cases, which is one in the equity market and one in the derivatives market. So basically, students, if you see, what was the original beta? Original portfolio beta was how much? 1.36. Revised beta is how much? 2.36. So this has increased. Why? Because he has increased the beta by taking the same position in the futures market. He should have not taken the same position. He should have taken the opposite position to reduce this beta. But since he has taken the same position, that means the impact or the risk that he's carrying has increased. Okay, students. So this validates what mistake he has done. Because of that, only the revised beta is coming out to be higher. Very easy, very logical, very simple. So this is all based on the detailed concepts that we have studied in the previous session. And students, please note that some of you would be thinking in this that why can't we just simply calculate the revised portfolio beta after having these revised values? That we can't do. The reason being, because you can't take 13 lakhs into 0 and 82 point this multiplied by 1.6 and then calculate. Why? Because in that case, you are ignoring the long position on this 100 lakhs. That also needs to be taken care. Correct? So using that, the answer would be very much different because we have to ignore that way of calculating it. We have to stick to what is the percentage change in portfolio and percentage change in market for calculating the portfolio beta here. Because if we don't do that, then we are ignoring this 100 lakhs worth of loss here. Okay, there are some queries on from Yash on question number 5. Let me again discuss the question number 5. Okay. Okay, so basically, I think Yash, you are asking on the entire this thing. Okay, let me cover the principles on hedging again, so that because this question number 5, 6, and 7 are based on that only. Just a second. Yeah, here. Let me cover this part so that it is clear again. Yeah. So students, basically we discussed that how can we do the hedging, correct? What are the basic principles of hedging? Now we said that hedging means that already we have one exposure in one market and we have to do the second exposure in the second market. For that, we said that, okay, we can use the same stock to do the hedging. Same stock means for the same stock we are doing in cash market, and for the same stock we are doing in the derivatives market. So for that, we said, okay, you take a equal and opposite exposure or position in both the markets, correct? Equal means that if you're purchasing one share in cash market, you short sell one future in derivative market. Or if you are short selling one share in cash market, you purchase one future in derivative market. That's what we studied in the same stock cases. Now, we said that since the stock and market is also related through beta, so hence we can use beta also to calculate the hedging amount. How can that be calculated? We will just first see that what is the value of shares, what are the total value of shares for which the hedging is required. In that, we will multiply the beta minus required beta. So beta is the current beta that we have, minus required beta means whatever is required. For example, in all the questions that we have solved, it is 0 because we want a perfect hedging. Perfect hedging means that the required beta is 0. Whatever is this value coming out to be, that we will divide with the index price multiplied by the lot size to arrive at the number of contracts. So this is what the simple and basic thing that we have studied. And we also said that is beta is positive. That means we have taken a long position in beta, then we will take a short position in the other market, which is taking the opposite position for the index futures. And if it is short, we will take long. But if beta is negative, that means already both of them are moving in the opposite direction. So hence, we will have to take the similar position in the same market, in the different markets. Okay. So let me go to the next question. In this question, again, we'll revise all these concepts, how to calculate beta, what is the portfolio thing. In this also, let us try to solve this question. Which position on index future gives a speculator? Now here they are using the term speculator. And they're asking which position. Position means whether to buy or to sell. They're saying a complete hedge. Complete hedge means the beta should be 0. The required beta should be 0. Then only they are able to do the complete hedge against the following transactions. So the first transaction is what? The shares of Right Limited is going to rise. There are shares of Right Limited that are going to rise. He already have a long position. That is valid. Because if there is an expectation to rise in the prices, one should take a long position. On the cash market of 50 lakhs of Right Limited that he has, the beta is 1.25. So basically, he has a long position here of 50 lakhs at the rate of 1.25 beta. Second is the shares of Wrong Limited is going to depreciate. They are going to go down. Now, if the shares are going to go down, would it be okay to have a long position or short position? It would be okay to have a short position, because if the prices are going down, you can make money by short selling it. Refer my first session in which I told that if prices goes down, you can still make money by using short selling. So he has a short position on the cash market of 25 lakhs on the wrong limited. The beta of wrong limited is also given as 0.90. This is actually first part. This is second and this is third. Okay. The share of Fair Limited is going to be stagnant. So they are saying there is no expectation on Fair Limited to go up or down. He has a short position on cash market of 20 lakhs. Still, he is holding a short position of 20 lakhs on Fair Limited, and the beta is 0.75. Can we just tabulate all these things? Because this is long, this is short, and this is also short. Now they're asking us that which position on index futures will give him a complete hedge. These are all shares, and we will use index futures to do the complete hedging. Let us try to formulate it. Company name. Company name is what? Right Limited. Then Wrong Limited. And third one is Fair Limited. So the value that has been invested is 50 lakhs here. 25 lakhs we have short sold here. Okay. And another 20 lakhs also we have short sold here. Beta is how much? Beta is 1.25, 0.90, and 0.75. These are the three betas given. Okay. This 50 multiplied by 1.25 comes as 62.50. Now, what we're trying to calculate is here is beta adjusted value. Because on that beta adjusted value only, we will have to do the hedging, correct? So 50 multiplied by 1.25 gives us 62.5. This gives us 22.5, and 20 into 0.75 gives us 15. So this gives us 25. How 25? Because this has a long position, this has a short position, and this also have a short position. So what we have to do is we have to calculate 62.5 minus 22.5 minus 15, because we are trying to calculate the net exposure. The net exposure is calculated how? Long minus short. So there is a 25 net exposure of still long, correct? Because this is coming out to be 25 long, correct? So that means, so if I explain you in other terms here, 62.5 you are carrying a risk that the price might go down. In this, you are carrying a risk that the price might go up. And in this also, you are carrying a risk that the price might go up. Because once you have done a short selling, then the risk is the price going upwards, correct? But you are able to eliminate the risks here with each other to some extent. So hence the only residual risk or the balance risk to be mitigated is 25, and that too on a long position. So what we have to do is, for this 25 lakhs, we need to take short position we need to take the short position in index futures. Okay, now Yash is asking that why we have taken a beta adjusted value. Yash, please pay attention to again the principles of hedging. So, Yash, to answer your query, you are asking why beta adjusted value. See, what we have already covered here is that if we are going to do the hedging using the market index, We will do beta minus required beta, and then we will multiply with this value. This is called as beta adjusted value. This entire equation is called as beta adjusted value. Okay. And the reason why I told you we have to do is because why beta adjusted value. I'm answering that. Okay. Why beta adjusted value? Because if you see, this is a stock, this is a market. What is beta? Beta is relation of stock to that market. Relation of stock to that market. I think, yes, this beta we have further explained in the portfolio management. Portfolio management, there is a complete session on the beta itself. So this gives, so what is beta? Beta is a relation of stock returns to that of a market return. So that means if beta is equal to 2, that means if market is giving you a 20% return, the stock will give you 20% multiplied by 2, which is 40% return. You're getting my point? This is what beta is. If market is giving you 10% return, beta will give you stock will give you 20% return because beta is 2. If market is giving you minus 5% return, the stock will give you minus 10% return because beta is 2. So here minus 5% multiplied by 2. This is what beta is. And if you have a value of 100 rupees in stock that needs to be hedged, can you say that 100 rupees straight away you take it here in the market? No, right? Because this return is adjusted on beta, correct? Because both the returns are not same. Market return and stock return are not same. Both of them are related to beta. Hence, you have to adjust here beta. So that means 200 worth of rupees of index you will have to deal to hedge 100 rupees of shares. Hence, we have adjusted the beta in the value. Okay, Yash? Okay, now coming to the second question that Yash is asking is how can we adjust the long, short of all the three companies? All of them are three independent companies. How can we add them? Okay. So Yash, first of all, if you see, we are not adding the shares here or we are not adding the value. What we are adding is the exposure here. What is the exposure? Exposure of Right Limited in relation to market is 62.5 long. Exposure of Wrong Limited in relation to that of a market is 22.5 short. Exposure of Fair Limited in relation to that of a market is 15 short. Okay. We have total of how much long and total of how much short exposure. Total long exposure is how much? 62.5. Total short exposure is how much? 22.5 plus 15. Which is 37.5. You have a total exposure of 62.5 long and total short exposure of 37.5. Now you tell me if they are independent. Okay, what I'm going to do is, now yes, you tell me, basis the concept that we have studied, if we have a long position of how much? 62.5 and you have a short position of 37.5, correct? I am not adding them. I am not adding or negating them. You tell me in futures market, what position will you take in for what amount? For long, you will take what position, Yash, in futures market? And for what amount? Whether you will take long position for this and short position for this. I'm just trying to elaborate what the query is. If you have a long position of 62.5, tell me in futures market, what are you going to do? This is already the beta adjusted value. You don't have to adjust any beta here. So what you are going to do in futures market, Yash? Okay, let me explain. In futures market, we are going to do short of 62.5. And against this short, we are going to do long of 37.5. Now, futures are same only, whether you do short or long. Instead of doing short of 62.5 and long of 37.5, can't we say that 62.5 minus 37.5, which is 25.25 simply, which is this 25. So can't we say that straight away do 25 short? Correct. This is what, yes, you have also mentioned, short 62.5 and long 37.5. This is what I have also mentioned. I'm saying, since both of them are same instruments, same instrument will be short and same instrument will be long. Why you want to take two different things? Just take the net thing, 25 short. The answer will be same. And this, to arrive at this 25 short, is what we have added here, added and subtracted. So 25 long is the still net exposure left. To curb this, we have mentioned 25 lakhs we need to take short position in index futures. Okay, Yash. I hope this query is clear to you. This question is completed. Yes. So we have completed what the question is asking. Correct. Now let us go to the question number 9. Okay, no issues, Yash. No issues. But your answer is right. We will do short of 62.5 and long of 37.5. Hence, what I'm trying to say is that instead of doing the same future short and long two times, let's just take the net amount and do the net short or net long. Okay. Then question number 9 says Ram buys 10,000 shares of X Limited at a price of 22 rupees per share. First of all, he's saying that Ram is buying, that means he's taking a long position in X Limited at a price of 22 rupees per share, whose beta value is 1.5. Correct? The beta is 1.5 and sells 5,000 shares at a price of 40 per share, having a beta value of 2. Correct? So some shares he's purchased and some shares he has sold, having a different beta values. He obtains a complete hedge by Nifty futures at rupees 1,000 each. Now here is the catch. They are saying that the complete hedge is obtained at by Nifty futures. Now, what position he has taken in Nifty futures, they have not told us. That we have to find it out. He closes out his position at the closing price. On the next day, when the share of X Limited dropped by 2%, A Limited appreciated by 3%, and Nifty futures dropped by 1.5%. What is the overall profit or loss to Ram? Now, let us try to, first of all, put all these amounts that are given in a proper tabular or in a proper structured format. So, first of all, we need to know that we first of all have the number of shares sold and bought, but we don't have the number of Nifty futures that we have to take a long position or a short position to obtain a complete hedge. For that, we are first calculating the net exposure. Calculation of net exposure. Long limited, sorry, we have taken a long position in X Limited, and we have taken a short position in A Limited. Now, what is the share price? 22 rupees. Number of shares is 10,000 shares. And straight away, we will go to the beta value also. We will adjust the beta here as well. Correct, Yash. That's right. Your answer is right. So the first one is 3,30,000. The second one is 40 multiplied by 5,000 multiplied by 2. Okay, so this comes as 4 lakh rupees. So this is a long position. This is a short position. Now, again, we will just calculate the net exposure here. We are not adjusting anything else. So the calculation of net exposure means the net short position left with us is how much? 70,000. Correct. And what is the lot size? Lot size is given as 1,000. No, so they are saying that the 1,000 rupees is the Nifty price. Sorry. So this is not the lot size. This is the so basically number of contracts. This is we have to take a long position because this 70,000 is net short position, correct? So the perfect hedging can be obtained by taking a long position in Nifty contracts, correct? Is 70,000 divided by 1,000. That means 70 contracts is what we will have to take a long position. Yeah. So net is 70,000. Okay. So the long position in futures at the rate of 70 contracts is what we'll have to take. Okay. So yes, I think in the short position, you multiply it by 2, then you will get 70,000. Otherwise, you will get 1,30,000. Okay. So we'll have to again take the beta adjusted value here because beta adjustment is done because of the formula and because of the understanding that we have taken just now. Now the next part is to calculate the gain or loss. Calculation of net overall profit slash loss. So X Limited. Now, students, if you see in all the securities, he has either so wherever he has taken a long position, the prices has dropped. Wherever he has taken a short position, the prices has appreciated. So he's incurred losses all around. Okay. So X Limited, first of all, 22 multiplied by 10,000 shares he holds. This is the total value of holding. On that, he suffered a loss of 2% because the price is depreciated. Similarly, A Limited, which he has short sold at the rate of 40 into 5,000 shares, on there also the value appreciated, hence he has suffered a loss there as well of 3%. And Nifty, which he has taken a long position, on that also, since it has depreciated, so he has suffered a loss there as well. So all the places he has suffered a loss: 4,400, 6,000, and 1,050. Total 11,450. This is the loss that he has incurred. Because we say that the question says is the Nifty futures dropped by 1.5%. A Limited appreciated by 3%, and X Limited dropped by 2%. So all the three positions are resulting into a losses. Okay. I hope you all are able to dissect this information. Students, please do ask questions wherever you feel stuck or wherever there are doubts in the mind, because then it will help to clarify a lot of things and make all our understanding better. Okay, so this was question number 9. Now let's go to question number 10. I think a very good question again, which has a complete blend of all the things, almost all the things that we have studied till now. So let's try to attempt this one. Question number 10 says, details about portfolio of shares of an investor is as below. First of all, they are saying that there is a investor who has a portfolio of shares, and these are the shares that are there. A limited, B limited, and C limited. There are three shares. There are three companies' shares. Numbers are given. Prices are also given, and beta is also given. Okay, now very good question. Yash is asking a very good question now. He has tried to do a hedge, but in this case, there is a loss. Correct? Now, what has happened here is, Yash, if you see, the hedging is done. Basis the beta of what? I'll tell you, one inherent problem with this is what? See, we said that X limited and A limited, correct? What is the beta that is given in question? This is 1.5 and A limited beta is 2. Now, if X limited is dropping by 2%, correct? So there is a X limited, there is a drop by 2%. That means the index should also drop by 2% divided by 1.5, correct? 2 divided by 1.5, which is around 1.33%. The index should drop, then only this 1.5 beta will make sense, correct? Similarly, if A limited is appreciating by 3%, then the market index should be 3 divided by 2, which is 1.5. 1.5 percentage, it should go up, and as per this, it should go down by 1.33 percentage. But if you see, there is no relation at all. In the last line of the question, X limited dropped by 2 percentage, this by 3, and Nifty futures by 1.5. You're getting my point? If there is an inherent issue in the figures that are given, what is that inherent issue? If there is a beta of 1.5 and 2, the figure should move in that relation, but the figures are moving randomly. There is no relation at all. Beta is just a number that is given to you just to calculate whatever is expected out of the question. Hence, your complete hedging is not coming out of from here, because complete hedging is what? Complete hedging is based on the premise that there is a factor called beta. Beta will govern the way the movements will happen in a relative manner in both X and in the market. You're getting my point? So hence, if you see, there are ad hoc movements. X is dropping, but A is gaining. According to me, if you ask me, if X is dropping, A should also drop, because both of them have a positive beta, and then market should also drop. We're getting my point. This is why we are not getting a complete hedge here. Yash is saying X with relation here. What is the X relation? X don't have a relation with A and Nifty, is what I'm trying to say. Basis the 1.5 and 2 times of beta that is given to us. Okay, Yash. If let's say X is dropping by 2%, and then it should be mentioned that A Limited will also drop, correct? And Nifty will also drop. Nifty will drop by how much? 1.33 percentage. And this will be 1.33 multiplied by 2, which is 3.66 percentage. So there is a drop in A Limited by 3.66. Nifty, there is a drop of 1.33. And X, there is a drop of 2. Then you will get a complete hedge. Okay, because now all these numbers are in terms of the relation to beta. Okay, but forget this part because the question is drafted in such a way that we have to calculate the net overall profit or loss. Initially, we have done the hedging, keeping in mind that there is a beta and everything will move in relation to beta only. Okay. Yes. So coming back to the question number 10. So question number 10 says details about the portfolio of shares of an investor is as follows, in which the shares, number of shares, price per share, and beta is given. Okay. No, no, yes. No, X and Nifty beta almost match. No, no. See, yes, what I'm trying to say. Okay, coming back to the same question. See, this 1.5 and 2. Okay, so the Nifty beta, first of all, is 1 because it is a market beta. Okay, and X limited beta is how much? 1.5. Now you tell me if X limited is 1.5 and the X limited is dropping by 2 percentage, then how much Nifty should drop by? Nifty should drop by 1.33 percentage, not by 1.5 percentage. You're getting my point. If that is the case, then only the perfect hedging will work because perfect hedging has been devised in such a manner that the betas has to be the outcome of the percentage change has to be in relation with beta. Okay, yes. So what I'm trying to say is that let's restrict to what the question is asking. Otherwise, if the numbers are given in question like in such a manner, because in our previous questions, we have been only given that the X limited price drops or increases. In that case, we used to find that in that case, what is the Nifty or the market index price is going out to be. Okay. No, no, yes, the answer will be same if he is doing the individual hedging also. You just try it because in individual hedging, he will take a 3,30,000 short position and 4 lakh of long position in the hedging. The answer what we have calculated will be same. Okay, Yash. So I'm just going to the next question. The investor thinks that the risk of portfolio is very high and wants to reduce the portfolio beta to 0.91. Now, first of all, he's saying that there is a portfolio of ABC Limited. Number of shares are there, prices per share, and beta is also there. The investor thinks that the risk of portfolio is very high. Number one, so he wants to reduce to the 0.91. He's considering the two mentioned below alternative strategies. One is dispose of a part of his existing portfolio to acquire risk-free securities. Okay. So what he's going to do is he's first of all taking some portfolio, sell it, and acquire some risk-free securities because the moment he will acquire risk-free securities, the beta of risk-free securities is 0. Or what is the second strategy? Take appropriate position on Nifty futures, which are currently traded at 8125, and each Nifty point is worth rupees 200. 200 is lot size. 8125 is the Nifty price. You are required to determine the portfolio beta. Very easy, very simple. Calculation of portfolio beta. Now the portfolio beta here can be calculated very easily, right? We can just take A limited, B limited, C limited, the weights and the respective betas. What is the number of shares that they have acquired is, sorry, let me put it here. 342. Okay. Price is how much? 500, 750, 250. All of them he has taken a long position. Okay. Then beta is how much? 1.4, 1.2, 1.6. Value is how much? 1500, 3000, and 500. Now, how we have calculated this value is 500 into 3, which is 1500. Correct? This is the total value of investment. 750 into 4, which is 3000. 250 into 2, 500. Okay? This is the value. Can we calculate the percentage weights from this? 15 plus 500 is equal to 2000, and 3000. 5000 is total. So 5,000, 15% is 30%, 15,000 is 13%. This is 60%, and this is 10%. Total 100%. Correct? So we have calculated the respective weights. Now beta adjusted to these weights. Correct? That is what will give us the portfolio beta. So 30% multiplied by 1.42, 0.42. So 30% multiplied by 1.4, which is 0.42. 60% multiplied by 1.2, 0.72. 10% multiplied by 1.6, 0.16. The total comes out to 1.3. This is what the total is coming out to be as a portfolio beta. So hence, portfolio beta is equal to 1.3. Now students, please note that current portfolio beta is 1.3. What is the required portfolio beta? 0.91. That means there is a reduction required. Now the second part, he's asking the value of risk-free securities to be acquired. See, if you see in the first part, they are saying that the first strategy is that he can acquire risk-free securities. Correct. Now they are asking us how much risk-free securities he should acquire so that the portfolio beta reduces from 1.3 to 0.91. Very easy. If we analyze this, so I'm saying the value of securities, risk-free securities to be acquired will be how much? Let's say the X. So X multiplied by 0. 0 is the beta of risk-free security. X is the amount of risk-free security plus 1 minus X, because the balance amount will be invested in the portfolio having a beta of 1.3 multiplied by 1.3. This whole total should be equal to 0.91. Simple. 0.91 is the required beta. So if we solve this, this is 0 plus 1.3 minus 1.3x is equal to 0.91. So x is equal to 0.39 divided by 1.3, which is equal to 30%. So x is equal to 30%. That means 30% of the existing portfolio need to be sold and the risk-free securities need to be acquired. So the amount to be disposed of is equal to 5,000 is the current multiplied by 30%, which is 1500 lakhs is the risk-free securities required to be acquired. Then what is the third part it is asking is the number of shares of each company to be disposed of. Now they are asking that 30% is on overall portfolio. What is the individual number of shares that we have to dispose of? Number of shares to be disposed of. Simple, it is 30%, 30%, 30%, and 30% for all A, B, and C. So it has 3 lakh shares, 4 lakh shares, because proportionately it will get reduced. Then only, because we are talking about a portfolio which is also working in that proportion only, correct? Zero point 0.90, 1.20, 0.60. So these are the number of shares that has to be disposed of at an individual security level. Now, the next part is the number of Nifty contracts to be bought or sold. Now, this is stemming from the second point, which is the second strategy. Now, let us read out the second strategy again. Take appropriate position on Nifty futures, which are currently traded at 8125. Okay. Now, students, please note here the formula, the first time the required beta will come into existence. Now you tell me what is the, okay, first me like to write down the formula here, that will make it easy. So number of contracts is given by beta minus required beta multiplied by value of portfolio, this whole divided by index price multiplied by lot size. Correct? This is what we have been doing. This is what we have been doing, correct? In the entire solution previous to these, but required beta we always took as 0 because we want to do a complete hedge. Complete hedge means where there is 0 risk. 0 risk means beta is also 0. Correct. But here we have given that required beta is 0.91. Simple. We will just put everything here. Sorry. So what is the current beta? 1.3. So 1.3 is the current beta. 0.91 is where we have to go. Multiplied by 5,000 lakhs is the value of portfolio divided by current price is 8125 multiplied by 200, which is the lot size. This is also given in question. 8125 and 200 is the lot size. So the number of contracts to be, now here comes the catch. What we have to do as a operation here, whether we have to purchase or whether we have to sell. If you see, he has purchased the shares. He is currently holding all these shares. If he is already having a long position in all these shares, he will have to take a short position in the index. So 120 contracts. So basically we have to take a short position. So we have to take a short position on 120 contracts. Okay. Now wait, let me go to Yash query. Yash is asking part 3. Okay, explain again. So Yash, see part 3 is again not basis some concept, it is simply asking, see, if you see the flow of question, okay, what is the flow of question saying? Flow of question says that an investor is currently having these three shares and he is of the view that the current portfolio beta is on a higher side. He has to reduce the portfolio beta. For reducing the portfolio beta, he is considering two options, option number one or option number two, one and two. One is that he will sell the existing shares and acquire risk-free securities. Because the moment you do that, you will get a lower risk, overall risk. That is, overall beta will be lower. Or second thing is that you complete the investment as is, but you take a opposite position in Nifty futures. That is the second part. Now the third part is asking you that how many individual shares has to be disposed of. Now we have already seen that 30% has to be disposed of as per the calculation done in second part. We know that to arrive at 0.91 beta, we have to invest at least 30% of 5,000 in the risk-free securities. That means all the shares in equal proportion has to be sold. So A also has to be sold 30% of 3 lakh, which is 90 to 0.90. 4 lakhs 30%, 1.2. 2 lakhs 30%, 60,000 shares. So these all shares we have to sell. This is what the question is asking. Okay, good question from Naveen. Now in these kind of questions, do we have to consider the adjustment in one or two or work out with original data set? Okay, Naveen, what I'm trying to understand from your question is, I think you are trying to ask that already we have considered the first part. Now, is there a need to consider that and again solve the question? So if you see, the question will give you the direction itself, Naveen. Okay, if you read it very carefully, it says or. Okay, so it says that either it will take step one or he will take step two. If he's taking step one, then accordingly they have asked 1, 2, 3, 4, correct? And if he's taking step two, then they are asking part 4, the number of Nifty contracts to be bought and sold. Yes, second part also. Okay, so second part, there is nothing much, yes, because we have first of all assumed it to be X, and whatever is the investment in risk-free securities will be done at a zero price, at a zero beta value, because the risk-free securities have a zero beta. We have just formed this equation basis simple pure logic. If 0 multiplied by X is this, plus 1 minus X is the balance investment in portfolio, multiplied by the current beta of portfolio 1.3, overall has to be 0.91. If you solve this, you will get X as 30%. Okay, Yash? So basis the second, we are able to calculate 30%, and basis the third, we are able to calculate this. Now let us go to the last point. The value of portfolio beta for 2% rise in Nifty. Now they are saying that what will happen? Ultimately, you have done this operation, which is the Nifty contracts you have already sold. And now there is a rise in Nifty by 2%. Then what will happen? You have already done a hedging. What you have done a sale. So let us see, this is the fifth part now. So how will the portfolio get impacted? So students, if you see, there are two things here. One is the portfolio of 55,000 lakhs and one is the Nifty futures, correct? Forget the risk-free securities because this is a separate part, okay? Forget risk-free securities because this is a separate part only on Nifty futures. So just focus that there are two things. One is portfolio of 5,000 lakhs, which is a long position, and you have taken a short position on 120 contracts, short, at the rate of 8125 for 200 lot size. This is the lot size. Okay. These are the two elements that you have now. You know that Nifty has taken a rise of 2%. Correct? Nifty, there is a rise of 2%. If Nifty rise by 2%, what is the portfolio beta? Portfolio beta is 1.3. That means the portfolio value will change, percentage change in portfolio. So yes, basically you can put the 30% value in this equation again and see whether you are getting 0.91 or not. Instead of X, you put 30% and try to see, you will get it. Okay, this will validate your answer. Because you're asking how to check whether second part answer is right or wrong. I'm saying put this 30% in the left hand side of the equation. Only in left hand side you will get the RHS, which is the right hand side of 0.91. Okay. Now, please focus here. Please, I want all of you to please pay attention here, because again, otherwise this will go for a different understanding. So Nifty futures is 2% up. Portfolio beta is 1.3. Can we calculate that what is the percentage change in portfolio? Definitely yes. 2% multiplied by 1.3. This is 2.6%. That means the portfolio will go up by 2.6%. The Nifty will go up by 2%, and hence there is a portfolio beta of 1.3. Correct? This is well understood, because here I'm using the same concept. Beta is equal to percentage change in portfolio, percentage change in market index. Correct? Yes, I think you are again and again repeating the same question, but you're not able to get what I'm trying to make you understand. Okay, yes, please listen very carefully again on the second part. 30% is coming from this calculation of X. Can you see this? X is equal to 0.39 divided by 1.3, 0.39 divided by 1.3 comes as 30%. This is the value of risk-free securities to be acquired. Okay, yes. I would request you to please go through the same part of the session again, in case.
Devas?
Yes, sir.
Devas, if the student is facing any problem and is repeating the question, I think it is better he can refer the session again and again.
Yes,
because
yes,
otherwise class will be delayed for the other students.
Yes, sir. Yes, sir. Yes, sir. Sure, sir.
Okay.
Sure, sir. Yes, sir. Thank you.
In case if a particular student have any problem, he can contact me over the telephone.
Sure, 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 sure.
Okay. Please.
Okay, sir. Yeah, yeah. Thank you, sir. So yes, we would request you to go through again the same part of the lecture, and you will try to get what is the exact solution discussed there. Now let us move forward. So we were discussing on the fifth part. Okay. Now, fifth part, the percentage change in portfolio we have calculated as 2.6%. Percentage change in market is given as 2%. This we have calculated using the formula that we have mentioned here. Correct? So we have to now calculate. See, now what is the question saying? Let us go to what the question is saying. You are required to determine the value of portfolio beta for a 2% rise in Nifty. Correct? Now let us see. The current portfolio is how much? The current portfolio is 5,000 lakhs. Correct? This is the current portfolio. Portfolio value after rise would be how much? portfolio value after rise will be 5,000 multiplied by what is the percentage change? 2.6 percentage, correct? This, if we add in 5,000, we will get the portfolio value after rise, which is 5130 lakhs, correct? But there is also a futures that you have sold, 120 contracts that you have sold, and there also there is a rise in percentage that will impact your portfolio return. Why? Because this is a loss to us. We have taken a short position and the prices is going up, we will face a loss here. So loss on futures. 120 are the contracts, multiplied by 200 is the size. 8125 was our initial price, correct? And that multiplied by 2%. This is the loss to us on futures. Okay. So this comes as 39 lakhs. Okay. That means the overall value of portfolio will be 5130 minus 39. Correct? This comes as how much? 5091 lakhs. This is the value of portfolio. Now, can we calculate what is the percentage change in portfolio? Yes, percentage change in portfolio will be 5091 minus 5000 divided by 5000. If we do this, 5091 comes out as 1.82 percentage, correct? And we are already given that percentage change in market is how much? 2%. That means the beta will be 1.82 divided by 2, which is 0.91. This proves that whatever hedging we have done to reduce our beta is actually what we are also getting here. Okay, students. Now, students, again, some of you would be thinking that why we have not just simply taken 5130 multiplied by the respective beta of that to calculate the portfolio, but that is wrong. Again, why that is wrong is because in that we are ignoring the loss on futures, because now that is also part and parcel of your portfolio. That will also impact the value of portfolio, correct? So always to calculate the revised beta, we need to see that what is the percentage change in portfolio and what is the percentage change in market index. That will clearly give us what is the beta, revised beta. Okay. Now, students, let us go to the next question. This is related to margins, and this is a very important and very good question because a very practical question. So what happens is, students, before going to the question, as I have briefly touched upon in the previous session, there are two kinds of margin. One is the initial margin, and one is the subsequent or maintenance margin, we can say. So students, what happens is, because we deal in stock exchanges for futures, now stock exchange just to secure the future cash flows, because if I am incurring a loss, I have to pay to the stock exchange through the stock exchange, correct? Now, just to secure that amount from me, stock exchange will ask for an initial margin. That is the only investment in futures. That also we have studied yesterday, because we don't have to pay for the 100% amount. We only have to pay for the margin. Now that margin is actually a result of, now what is this? This is the average historical returns. This is called as mu, and this is the standard deviation of historical returns. Now, please let us not go into the logic why it is average plus 3 times of standard deviation. I will try to give you this logic once we cover the options in the normal distribution table. But as of now, we have to just see that average plus 3 times of standard deviation is what the initial margin is, correct? And then what is the concept of maintenance margin? So maintenance margin says that if in case, so what is happening is in initial margin, you will deposit that amount. And once the transaction keeps on happening, the margin will go up or down. So maintenance margin is actually given in the question, but for example, it is 75% of initial margin. So what it will say is once the amount goes below 75% in the margin account, the investor has again to bring back the amount to make it equal to the initial margin. You're getting my point? So this we will try to understand it better from this question. Now, question number 11 says Sensex futures are traded at a multiple of 50. This is a lot size that is they have clearly given. Considering the following quotation of Sensex futures in the 10 trading days during February, what are those? These are 10 days that are given high, low, and closing. First of all, students, please note high and low is of no use to us because the mark to market settlement happens on closing. Mark to market settlement happens on closing. Please note this point, all of you students, that the high and low is of no use. Only closing will have to see. And the closing prices are also given here. Simple. Now, Abhishek bought one Sensex futures. Now, one Sensex futures is multiplied by 50, correct? Just remember that. On February 4. So he purchased one Sensex futures on February 4. The average daily absolute change. Now, students, please note the language that question is using. The average daily absolute change in the value of the contract is 10,000. So 10,000 is nothing but mean of, because it is saying average. Average is what? Mean is 10,000. And the standard deviation of these changes is 2,000. So standard deviation is given as 2,000. Simple. The maintenance margin is also given as 75% of the initial margin that is specified. Now you are required to determine the daily balances in the margin count and the payment on margin calls, if any. Okay, now let us try to attempt this question. So first of all, we know that initial margin is how much? 10,000, which is the average, plus 3 times multiplied by the standard deviation, correct? So it comes as 10,000 plus 6,000 is 16,000. Initially, to invest in one contract, he has to deposit 16,000 rupees. Simple. Maintenance margin is 75%, which is equal to 12,000 rupees, correct? So this is 16,000 multiplied by 75%. Simple. Now let us try to see how the account will look out. So first of all, let us put days here. Changes in future price, then margin account, and margin call money, which is the additional money if we have to put. What would be that? Simple. Very easy, very simple question. First of all, we have to see what position he has taken in the Sensex futures. He has bought. That means he has taken a long position. In case of long position, if the price goes up, he will gain. If the price goes down, he will lose. So on the first trading day, there will be no loss, no gain because he has purchased on 4th of February, correct? So he will deposit 16,000 here, correct? This is the first time. Then on the 5th closing, what will happen is now the adjustment of mark to market happen. 3294, the price has gone. From 3296, the price has gone down. That means he will lose. Okay, we have to calculate the amount of loss. 50 are the number of contracts. 32 94.40. Simply the difference between two, the closing will be the loss, correct? The only key here is we have to identify loss or gain basis the movement. If the price goes down, it is a loss. If the price goes up, it is a gain. 3296.50. This is minus 105. Now, what will happen? Stock exchange, what it will do for this loss of 105, it will adjust it will take from the margin money that has already been kept with the stock exchange. So it is 15,895. Okay. Then on 6th, what is the price? 6th again, is there a loss? 3230. Yes, there is a loss because from 3294 the price has come down to 3230. So again, for 50 multiplied by 3230.40 minus 3294.40. So there is a loss of minus 3200. Now, if we reduce 3200, it comes as 12695. Correct? Now, what happens on 7th? 7th also there is a loss. Loss of how much? 905. Now, students, please note, if the stock exchange is reducing from 12,695 another 905, then what will happen? It will go down below the 12,000, which is the maintenance margin. In that case, the investor is required to deposit further amount to make it to 16,000. So first of all, the margin account will reflect 16,000, but here the adjustment will happen like this: 16,000 minus 12,695 minus 905, which is the current day loss also, correct? So stock exchange will ask him to deposit more of 4210. So 4210, if we add in 12,695 and the loss is adjusted, we will reach to 16,000. Simple. Okay. Now I'm just putting the values here because this is the only catch in the question that I wanted to explain, that once it goes below the maintenance margin, then the stock exchange will ask you to deposit such money which will make your total amount to the initial margin. Okay, so it is 2760. Now, in this case, if he has gained on 10th, if you see the prices has increased, so 18,760 will become his margin account. Then on 11, he has taken a loss of 185. So here 18,575. Then on 12th, 12th again he has gained 1410. Okay, which will make his amount 19,985. Then 14th, again there is a gain 865. So in totality, so now if you see the stock exchange is adding all the gain to his margin account, correct? If there is a loss, it will deduct, but now here the stock exchange is adding all the amount here. Now on 17th, what will happen? 17th, now there is a loss, minus 2575. So 18,275 is the reduction now. Okay. Still the initial margin and maintenance margin hold the same, 16,000 and 12,500. Then on 18, there is a big loss of 7760. Now, the moment you reduce this amount from this, you will be lesser than the maintenance margin again. So he has to bring more money now. How he will bring more money? 16,000 minus 18,275 is the opening balance minus the current day loss. So this is the balance amount that he will bring in, which is 5485 rupees to make it equal to the initial margin. Okay, students. So this is the one question that we have included on the mark to market margins. This part we just leave it alone On the logic part, just remember the formula. Logic part will try to cover in the next part when we will cover options. Okay. So this is how his margin account will look like: daily plus and daily minus. Coming to the 12th question. So 12th question says that calculate no arbitrage forward price. This I have been repeating in the class. No arbitrage forward price means theoretical minimum price. We can call it any which way, because at this price arbitrage is not possible, whatever we calculate from the formula. For a 100-day forward on a stock that is currently priced at 30, so the spot price is given as 30. If I put it in a timeline, so this is, let's say, 100-day, correct? And is expected to pay a dividend of 0.40 in 15 days. In 15th day, we will get a 0.40 dividend. 85th day, we will get how much? Again, 0.40. And on 175th day, we will get a dividend of 0.50. Now, students, see what this question is trying to tell us is that there are 3 different streams of dividend that will be paid in 3 different time period, and the annual risk-free rate is 5%. You have to calculate what is the arbitrage-free price. Now, students, if I put as D1, D2, and D3, there are 3 dividends: 15th, 85th, and okay. Naveen is asking, sir, can you use the excess margin available to me? Definitely yes. If you want to withdraw this, you can withdraw this. Whatever is the excess margin. Let's say you have 20,000, you want to withdraw this, you can withdraw this, but up to the initial margin, which is 16,000, that you'll have to maintain, that you'll have to keep. Okay. Now coming back to this, in this, if you see one good observation, D3 is after the expiry. D3 is after expiry because expiry is on 100th day. So D3 we will have to ignore, because D3 will not have any impact on the valuation that we are doing now, and something is going to expire on 100th day. Okay, this is the only catch in the question. Now, if you see this 0.4 is on 15th day, we have to take a present value here. And similarly for this 0.4 also, from 85th day, we have to calculate a present value here. Then we'll have to take a future value of 100 days. Okay. So basically 0.40 is already a future value. The present value will be P1 plus P1 multiplied by 5% into 15 by 365. I'm using a simple interest here, correct? Not even compounding, because the relevant data is not given to solve it. Okay. I'm just using a very simple interest. So the P1 will be 0.3991. So 0.3991 is the future value of 0.40 that needs to be paid on the 15th day. Similarly, for P2, we will take same 5%, but instead of 15, we will take 85 here, correct? Because it is paid on 85th day. So the P2 will become as 0.3954. Okay, now the forward price. Again, we will use the simple interest only here. So this is 30 is the spot price minus present value of dividend one is 0.3991 minus present value of second is 0.3954, correct? Multiplied by 1 plus 15% into 100 day by 365 days. Simple. We have not taken D3 again here because that was falling beyond the required period. So the forward price 100-day expiry is 30.40. Although it is a very basic and very simple question, but the only catch is to ignore D3 here and to take the present values of D1 and D2. And don't get confused with no arbitrage forward price, because this price, at this price, there is no arbitrage possible. Correct? Let us go to the question number 13 now. So question number 13, question number 13 says a rice trader. Now see, this is a question on commodity derivatives, correct? Because we are talking about the underlying here as rice. A rice trader has planned to sell 22,000 kgs of rice after 3 months from now. Okay. So there is a 22,000 kgs of rice to be sold after 3 months. Please note he has to sell. That means futures also he will have to sell now. Then only he will be able to sell the rice after 3 months. Correct? The spot price is 60 per kg and 3 months future on the same is trading at 59 per kg. Simple. This is the future price. Spot price is how much? 60 per kg. If you see the future price is lesser than the spot price. Okay. Size of the contract is 1000 kgs. The price is expected to fall as low as 56 per kg. There is an expectation that in future the price will further go down. How can he protect himself? How can this rice trader protect himself? What the trader can do to mitigate its risk of reduced profit, it decides to make use of future market. What would be the effective realized price of its sale when after 3 months the spot price is 57 per kg and future contract price is 58 per kg. Very easy and very simple. Basic mathematics it is trying to tell us. So first of all, he has to sell the rice after 3 months. We have to devise a strategy that in case the price goes down, he will gain. What is that strategy? That means he has to short on futures, because then only if the price goes down, he will gain. So first of all, trader need to short rice futures, but we'll have to see at the rate of how much. The current future price is 59 per kg. For how much contracts? So if you see 22,000 is the plan to sell and 1,000 is the contract size. That means 22 contracts they have to short sell. Simple. As a first step, the trader needs to short sell 22 contracts at the rate of 59 per kg. Now what will happen after 3 months? Now students, please note, after 3 months, he will sell the rice at the spot price of 57 per kg, correct? So spot price is how much? 57 per kg multiplied by 22,000 kgs. So this is coming out to be 12,54,000 rupees. So this is the realization. And since he has short sold the futures at 59, and what is the future price after 3 months is 58. That means 1 rupee of gain he will make on futures also. So futures, let me put gain on futures will be 59 minus 58, because 59 is what the price he has short sold and 58 is the current price of future that has come. Correct. So 1 rupee on 22 contracts having 1000 contract size gave him 22,000 rupees extra. This brings us 12,76,000 rupees here as the total amount. Hence, the effective selling price becomes as 12,76,000 divided by 22,000, which is 58 per kg. Now, students, see the beauty here. Despite the spot price is 57, he is still able to realize 1 rupee more, which is 58 rupees per kg. Why? Because he speculated that there is a price going to go down, and hence for that speculation he acted by doing a short selling of rice futures. So once you do that, any decrease in price will give you benefit, which will keep you protected at 58 rupees per kg. Okay, we will just now cover the last question because that will end up covering our all the futures and forwards questions. Then from the next session, we can go on to the options. We will just take 5 minutes to discuss this. So question number 14, it says that a future contract is available on R Limited that pays an annual dividend of rupees 4. Okay. And whose stock currently is priced at 125. So we are given spot price and the dividend. Correct. But this dividend is paid at the end of the year. Spot price is today's price. Okay. So each future contract calls for delivery of 1,000 shares. So lot size is 1,000 in 1 year, daily marking to market. So daily mark to market is there. The corporate treasury rate is 8%. Okay. That is R is 8%. Given the above information, what should be the price of one futures be contracted for? Which is very easy. We'll have to just calculate the future price. One future contract will be spot price is 125 minus present value of dividend will be 4. Okay, now in this case, there is a 1 year future that we have to calculate, correct? Already 4 is given after 1 year. So there is no need to do present value first and then do the future value. So let us do one thing. Let us just simply do the future value of 125 and then reduce 4 rupees. Simple. So 125 multiplied by 1 plus 8% minus 4 rupees. This is already a future value of 1 year. And this is already we have given the value after 1 year. So the future price comes as 131. This is what the future price comes as 131. Now the second part, if the company stock price decreases by 6%, what will be the price of one futures contract? Now we are saying that the price decreases by 6%. What will be the prices of one futures contract? Simple. Spot price will have to reduce. The same formula, what we'll have to do is revised future price. So it will be 125 was earlier price, but there is a 4%, sorry, there is a 6% decrease. That means it will be 94%. Okay. This comes as 117.50. From this, sorry, we will reduce. This is revised spot price, future value basically. Okay. Future value, spot price, this is this much. And revised future price will be, this is revised spot price that we have calculated here, and revised future price will be 117.5, 1 plus 8% minus 4. So this will be 1,22,900. This is the revised price on futures, correct? If we want to see that how much, it will be 122,900 divided by 1,000, which is 122.90. Correct? Then third point, what it says is, as a result of the company stock price decrease, will an investor that has a long position in one futures realizes a gain or loss? What would be the amount of gain or loss? Now here what we are saying is, investor is already having a long position. Any decrease in price will result in a loss for the investor, correct? Because long position will result in loss in case of price decrease. And the amount of loss will be nothing but the first minus second, correct? The first part calculation minus second. Amount of loss is equal to 1,31,000 minus 122,900, which is equal to 8,100. This is the net loss. Okay, students. So this is the net loss. So with this, we have completely covered the forwards and futures. In the next session, we will start with options and we will take our session from there upon.
Thank you, Divas.
Yeah.
Your session is over now.
Yes, sir. My session is over.
Okay, thanks for your efforts that you have made understood the student the concept of future in a very detailed manner.
Yeah.
Student, Devas, I want to take one or two query. Can I take the
Yes, sir.
same?
Yes, sir. Yes, sir. Please.
Student, there was one query in the beginning, like there was one student was asking some simple compounding or exponential compounding. Student, it is a very common doubt. In this regard, please note in the question if exponential value has not been given, so you can use simple compounding. Okay, and if the exponential value has been given in the question, please use the exponential values. Okay, because normally the exponential table is not provided in the examination, so we assume that the if exponential value has not been provided in the question paper itself, then you can do it, solve it with the simple compounding. Your no marks will be deducted, so don't worry about on the same. Even some students use some calculation jugglery and they can compute this value, so they can also do so like that. But if you do it by simple compounding, it will also be correct. Now regarding question number 10, I think there was one question, student has asked very good question. Sir, how to solve the values from the data? That is, I think there were two aspects. That is one from the taking the short position in the future, or adjusting the. You can say we can adjust the beta by taking the short or long position in the index future, or we can do by the taking the selling or buying the risky securities. So student, please see in this question, actually there it is a combination of two concepts. One is portfolio management, another is futures. So here, since it is actually you can say that because one student has understood the concept of portfolio management, then he can understand this question very well, because it has these are two approaches. The investor can follow any of this approach. Okay, so I hope, but you have to interpret from the data. Suppose in the data, if nothing has been mentioned, but you have been given only no mention is about the future contract. So of course, you have to adjust your beta by buying or selling risk-free securities. Okay, and if future has been value of future has been mentioned, then of course you have to take the resort to the root of future position. So student, I hope with this your concept must be clear. In case still you have any doubt, Divas, just write down the my email ID on a blank screen. Student,
Yes, sir.
you can write it to us SFM dash final at the rate ICI.in. Okay, we have also e-Sahayata portal also that you can find on very easily on the our website, and even you please note down my telephone number. You can contact me over telephone 0120 3045 956. So student, you can give me a call directly to me. So, and if you have any problem, then Dimas, do you want to say something more?
No, no, sir. That's all.
Okay. So in the next class, you will take up the option.
Options. Yes, sir.
Okay, Dimas. Thanks a lot, Dimas, for sparing your precious time
Thank you,
and
sir.
telling the student about the concept of futures in a very exhaustive manner. And thanks, student, for your patience listening and responding to, and you just use developing the connect with the sir in a very, because I was seeing your queries are very good queries are there.
Yeah.
Thanks a lot, student. Have a nice day. Okay,
Thank
Divas,
you.
thanks a lot.
Thank you, sir. Thank you.